everybody an across the board 10% increase, all of our global allies and foes getting punished because Trump got his hand slapped on the global economy. Wild stuff. We got the GDP and the PCE, and neither one of them were good for the market. The GDP came in extremely soft, and even then we saw the president attempting to kind of prepare us for that soft GDP report by saying it was largely due to the government shutdown, which does make some sense. However, this is good for the idea of the Fed being dovish in the days ahead, but not good if we slide into a recession. If the AI story doesn't hold, take root, and continue to climb in 2026, these markets would have one incredible rollover moment, especially when a lot of the growth stories as well as the software stocks have been abandoned so far. Then we would really see some dark days ahead. Now, I don't see that right now. Matter of fact, what I see is an economy holding up extremely well. I look at the SPY, the S&P 500, and I've been talking about this overall bearish ascending wedge. Now, those are only bearish when they break to the downside, and we recently tested the downside last week, but we bounced off of the downside, and we have moved right back into the middle of that channel, meaning that this market is not going anywhere. It's not heading south yet. It's actually holding up extremely well and showing strength going into that very big macro event next week, which is NVIDIA's earnings. An AI reality check and a macro market mover for sure. All right, let's kick things off and talk a little bit about some of the big data events we had this week. The GDP did not go the way we wanted it, and neither did the PCE. The PCE came in terrible. It went up 0.4% versus an estimate of 0.3% versus a prior read of 0.2%. So GDP was terrible, PCE was terrible. Well, what else do we get this week? We got Walmart's bad forward guidance causing the stock to drop nearly 10% from its recent high altogether. Wall Street is concerned about how the consumer is doing because they're saying they're not doing too well looking forward into 2026. All of this aligned into the incredible news that we got from the Supreme Court on Donald Trump's tariffs. And of course, he came front and center threatening more tariffs, but surprisingly, the SPY went up and NVIDIA did well today. And I think a lot of people are looking ahead and even looking past the drama and the noise right now. I'd love to hear from you. Are you bullish or bearish or confused on these markets? Let me know in the comments. All right, let's get into the important stocks I want to cover today. The first one being GRAL. And before I give you fresh technicals on that, let me explain to you why it didn't do well. First of all, I told everybody that the earnings event would not be an up catalyst, right? And that a lot of success had been priced in without the results. Now, even though the earnings event was not good, it was the results from their UK trial that came out and slapped the stock down. Let me share that with you. Grail's NHS Gallery study, about 142,000 people, did not show a statistically significant improvement in the key outcomes it was trying to improve over 3 years, mainly shifting cancers to early stages, reducing late-stage diagnosis, enough to meet the primary endpoint. So what does it mean? It means it didn't work. And like anything with medical or biotech, it got absolutely smashed. Now, if you followed the critical levels that I gave you, if this thing crossed beneath 93, I told you that that was the floor and that the floor would break down and that this stock would plummet. I expected to move down to $74, $75. It went way further. But before I get into the fresh technicals on GRAL, let me just remind you and show you the receipts of what I shared, 2 different clips from 2 different recent videos. Check this out. So there's your price range. There's your breakout and your breakdown. I'm interested in watching this play for a breakdown. I believe that if we do close beneath that critical level of 93, then we go to 84, then we go to 75. And I think there'll be money to be made shorting this stock if those earnings comes out poorly. This chart is very tradable right now. And largely, I'm looking for a breakdown, really, because it's hard for me to imagine that the earnings event, which is the analysis of the books for a company that's spending money trying to get FDA approval, is somehow going to push the stock higher. I think that the loss of funds and the lack of revenues would scare shareholders and put us in more risk to a move to the downside. Now, like I said in my recent video, this was tradable to the upside and to the downside. I gave you the breakdowns and the breakouts. These are the things you have to follow. You can't just go off of bullish sentiment or bearish sentiment. But as soon as we crossed that 93, we absolutely crashed and we had a massive $50 drop and a huge gap down. Now, this is a moment in time in which I think it's worth reminding you of my gap rule, which I've talked about on the show before, which means that if you have a major gap down moment, especially one that's driven by a fundamental news event like this, you have to wait 3 days for the market to reveal whether they think that was an overreaction or whether or not it was an appropriate action. And I would say that at the moment it showed weakness after it hit the ground and bounced. It's faded back to its low, so I wouldn't touch GRAL long at all right now. And if it breaks the low that it made, expect this to go much lower. So we're still watching GRAL for downside moves until the technical story changes. That's what we're doing with GRAL. Now, I haven't talked about this stock in a while. I'm gonna go through these very quickly, but we're talking about Nokia, NOK. Now, this is one that I called a buy on a pullback to 640, and it did something similar as well. It actually pulled back pretty hard and fell beneath $6.40. And I talked about it being a buy right then because its relationship to NVIDIA, as well as the company, I've always liked it. They simply chose a path very similar to other big tech companies, and it wasn't the right path, and they faded from Wall Street, but now they may be back. And I specifically highlighted when I did that Nokia video, the significance of recent RSI action on a high time frame. And sure enough, if you bought then, you're enjoying this thing as it's running up close to $8 now. And I just wanted to highlight and congratulate anybody that took the Nokia trade. And for me, this is still a long-term trade. Okay, so this is still one that I've got on a steady buy for accumulation, giving them the full benefit of the doubt. And the truth is, I don't own enough of it. So if it came down a little bit, that would be okay with me because I would keep doing a steady buy on Nokia. There are things you have to own for a decade to realize generational wealth. And in my opinion, Nokia is on that list. Let me know what you think about Nokia. If you're a swing trader, we hit my target or we're very close to it, which was given when I communicated this as a buy, which was a return to $8. So if you're a swing trader, you want to raise your stops and make sure you take some profit on Wall Street occasionally. For me, I'm going to hold this and keep accumulating it because I like its long-term trajectory. Now, it also is going up in sympathy with NVIDIA because maybe they will shout it out again. Maybe they increased their Nokia position. Who knows? But it is going up in sympathy with NVIDIA towards NVIDIA's earnings, which means that if you need to protect capital, you might consider seeing where this is at the night before earnings next week. That's why I'm talking about it today, because I'm trying to get you prepared and ask you, do you have a Nokia NOK trade plan? I do. I shared it with you. All right, Tesla is one that's positioned, in my opinion, to be the biggest player in this field in the United States. I've been really amazed by some of the robot videos I saw over the last week. That tech is screaming forward, and you're getting armies of Chinese robots doing backflips and kung fu and running with machine guns. It's scary stuff. I mean, but it's one of the reasons why, in my opinion, if something puts you in amazement and you're in awe at it, go figure out who's doing it and buy that stock. And so right now, I still loving my position in Tesla. I'm watching it very carefully. I haven't added anything new in recent days, but if we dropped beneath $400, I would add to it. Right now, we're hugging that 411 price, and if we lose 408 going into Monday or at any point next week, I think we're in trouble to go back below 400. But if we can close the week out above 415, then the bulls will have retaken charge of this. We need to close next week above 415 on Tesla. And the last stock I've got to talk with you guys about today is Alibaba, because Alibaba is also in a very critical spot. Right now, it could go either way, but I'm leaning slightly towards the idea of a move down. Now, you're going to get things like fake outs to the upside. This is one that I don't want to necessarily call the direction on. I don't have any puts right now for this to the downside, but I'm going to show you the triggers, the lines in the sand, and where we would likely go, where I would get very ambitious in my trading and investing on Alibaba. Let's quickly go look at that chart. So I'm looking at a very, very high time frame for Alibaba. I'm looking at the 2-month candles. This is a very long-term view. Now, this is very bullish how this has stair-stepped up, and I'm imagining that it's possible before the next leg higher that we could get a pull back all the way to 137 on this Fibonacci, which would be the 0.382 level. Now, that's where I would be an aggressive buyer. And I would love to see that pull back, and I would take some skip option calls to the upside for the next year. However, I want to be very clear. If we can get above 165, that's going to be our signal that we will hit 180 again and move all the way up to 192. So your trigger for a move to the upside is a close on the weekly time frame above 165. And if we got that, we would move very quickly. We have a 2-month candle, which is a gravestone doji, which is not an attractive candle right now, that we need to be mindful of, because that could give us a minimum pull back to the fib level of 0.382, a price point of 137, and it would be at that point an extremely bullish area for this to bounce. Now, the trigger to the downside on Alibaba is going to be a candle close to 4-hour candle close beneath 152. That would be my trigger for that move to the downside to be realized. Right now, we're between those two levels, which means that the decision or direction is not very clear. However, we've got a pretty ominous candle on a pretty high time frame. Let me know if you're doing anything with Alibaba. I'd love to hear from you. All right, let me just conclude this video with what is ahead next week. It's all about inflation next week when it comes to the data, but we also have the president on a rampage fighting the Supreme Court and possibly going to war with Iran, which will create some uncertainty and some fear in the markets, especially if there is some sort of a strike over the weekend. I could see us opening up much lower. So we need to brace ourselves and prepare for what's happening in Washington and its impact on Wall Street. Now, you know we don't get political in this channel. I can tell you that if we did go to war, you're going to see the war stocks pop and go through the roof. I also want to highlight that a lot of the nations, when they gathered in Davos not too long ago, all of them were talking about military buildup and looking ahead to get prepared for conflicts globally this year and next year. So that's what's going on. That's what we're watching for. It's going to continue to be a volatile environment. And if you ask me right now, we have threats that can cause the stock market to plummet. But we also have not broken down. We have not broken down. We're actually holding up very, very well. And we see that if the macro environment shifts with NVIDIA next week, they could reverse the Mag 7 and the software companies, and we could begin to get that blow off top that had been talked a lot about in 2025.
Illegal drugs and border issues coming in here. And then there was trade deficits. And he said those were national security. So he was able to use those as power and get them right in. Well, that's how the tariffs move so fast. That's how we got hit with Liberation Day. And the market sold off and $1 billion was lost. Well, the Supreme Court took a year and they ruled 6-3 against Trump, saying that they were not illegal, and even two of Trump's own people, which he did not like. Now, because it's the Supreme Court, y'all, there is no appeal process. That is it, meaning Trump cannot use brute force. He can't even use the same weapon again. And as we saw yesterday, the markets rally off that news. So, typical Trump, he goes backdoor, right? Came up with a new framework, Section 122. Now, because he's pivot to Section 122, which is the Trade Act of 1974. I just want to give you some structure and foundation before we get into this video so you can understand what's going on. Now, family, this is important because Section 122 is not infinite power. It actually has a leash, so he can only impose max 15% tariffs, which he saw he done that this morning. Immediately, he said 10% yesterday, 15% max today. Now, it can only be for 150 days, and after that, to be extended, Congress has to come in place. When we know Trump don't like going through Congress, he like doing things himself. So we just went from emergency, unlimited leverage to temporary cap. Now, that's a sign of relief for the market in one way, but you still got a lot to uncover. If you're in the market, you understand that markets shift when things like this happen because they get a little more clarity, they get some relief. Because the market don't just price in earnings. Markets price in policy, durability. So when tariffs are durable, companies build around them. And we've seen companies do that. When tariffs are unstable, companies delay decisions. So then you get hiring slows, you get CapEx slows, and you get growth slows. And if you head into an environment where inflation is sticky, growth is slowing, and policy is right now kind of unstable, then you want a business that can sell mission critical, boring products. And so that brings me to this first company I want to talk about. That's Brady Corporation, ticker symbol BRC. Now you ask yourself, Trap, what the hell does this company do? I'm glad you asked. Well, Brady makes identification and safety solutions. So they make labels, they make workplace safety signs, they make asset tracking, wire and cable identification, and compliance products. That's right. They sell the boring stuff companies can't stop buying. And that's what we want in an environment like this. So when tariffs are selling off and the market is spiking and whipsawing, we want something that is non-negotiable. So if you run a hospital, a factory, or a warehouse, an airline maintenance shop, you don't pause compliance because the market is up or down. Actually, your stock becomes steady. You actually double down because lawsuits and regulations, well, they don't care about feelings. And so BRC wins in this because it's non-discretionary demand. So when budgets tighten and companies cut marketing first, they don't cut safety compliance. Pricing power through necessity. And Brady isn't a luxury purchase. It's a small cost that prevents huge mistakes. This is a quiet compounding business, and Brady isn't trying to, change the world. It's quietly selling a picks and shovel to the industrial world. How does this tie into that ruling, Trap? Well, when tariffs start creating supply chain instability, as we can see, Trump is going to do what he can. He's going to find another back door. Companies reorganize logistics, and reorganization creates what? More labeling and tracking compliance. So when headline screams, chaos, 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 Brady sells the infrastructure that gives them order. And this is why I like this company. And I think you should just check it out. Remember, this is not stock advice. You should just check it out. Now, here's the part that most people aren't really saying out loud. This ruling doesn't just hit tariffs. It hits Donald Trump's strongman perception in the markets. Because the markets, they care about one thing. Who can enforce your plan? And as you can see, companies are excited that this is going on. And the reason why is because you have companies like Costco and, other companies that are actually suing Donald Trump. You even have a state that's actually suing Donald Trump that's saying, hey, Trump, because that's illegal and because that's the Supreme Court and you cannot reverse that. Our people need their money. Because the markets don't care, the markets just rally, right? And we have to be a part of something that can do what? Beat inflation. Again, 2 of Trump's own judges went against him. And of course, he said they were a disgrace to this world. That's some harsh words. Well, he's going to keep applying pressure, but through tools that are legal. And this means more excessive actions, more temporary measure, more negotiation headlines, more market whiplash. We know this man. He does not go down without a fight. He's going to scream, he's going to kick, he's going to cry, he's going to insult. And the markets can't keep looking that off. So you're going to get a headline shock. That's coming. Sell-off. Again, 15% tariffs this morning. Monday, we may get a sell-off. Negotiation headlines, relief rallies, and then some more headlines. Now, you got to think about this. There are countries like India and China with this 15% that's going to go on top of what they have now. But remember, it's only 150 days. Now, you got to think about it from another perspective as well as, now, remember, our GDP growth slowed down to 1.4 from the 2.8. And some of these people who we were doing business with actually just sought business with other countries. Now, those people aren't always going to come back. And I'll probably say 70% of them won't come back. So that means we're probably in a worse position now than we were before, which means Trump got a lot of explaining to do. Now, this is a trader's market, but it's also an investor's opportunity market. Now, here's the hard truth. Even if tariffs get removed or reduces, we know that prices won't drop. Because businesses, their prices are based on what consumers got used to paying, where their supply chain costs are now, and what competition allows. And a tariff is like squeezing toothpaste out. Removing the squeeze doesn't put the toothpaste back in the tube, which means you and I, who've paid these tariffs for a year, are stuck where we are, and companies will get rewarded that $175 billion. So consumer, we get no relief. But the market will still reprice because uncertainty changes margins, forecasts, and confidence. And this is why we need to be in the market. We need to be in the market because as market rallies and as market go up, that's how we get our money back. And I know it's not fair, but we don't live in a place where we get the luxury of being fair. Again, now we have receipts for the monster every investor needs to respect. Stagflation. Stagflation is when growth slows down. Remember, GDP came in at 1.4. They were expecting 2.8. But prices stay high because they're not going to go down. So you don't get the relief of a recession where inflation collapses, and you don't get the strength of a booming economy. That's why it's dangerous. So then you have a Fed that's coming in June, late May, June, that maybe give us some rate cuts. Well, think about it like this. Households feel the pressure. Companies feel the margin squeeze. Markets swing violently because the Fed is boxed in. And when the Fed is boxed in, markets get shaky. This is the environment where you don't chase hype, you buy durability. Now I'm going to lead y'all to something else, and I need you to be with me right here. This is one that's going to really make you question yourself. Maybe even question me. I like Apple right here. The reason Apple matters in this setup is not innovation, and it's not cool products. It's because it's tariff survival. Because of this, now things will kind of ease up on China a bit. And Apple is one of the biggest global supply chain stories on earth. When tariff policy is unstable, Apple benefits from three things: pricing power. Yep, they brand demands that. People don't buy Apple because it's cheap. They buy Apple because it's status and it's the ecosystem. And then between them and Samsung, I'm not gonna lie, they go back and forth. But Apple just sells more. But they go back and forth between every couple of years. So this means Apple can hold the pricing power better than most tech companies. And we are going to see that. And I don't think we got to look at Apple as a tech company. Look at it as a tech consumer staple. Think of it as the technology Walmart. Supply chain is number two. And flexibility. Well, small companies get crushed by supply chain shifts. Well, Apple can just redesign the procurement. They negotiate contracts and move manufacturing. You saw when they took all those chips, all those phones and flew them from China. And then they started doing deals in India. So Apple understands that. And it behaves like a consumer staple. This is why I'm saying, think of Apple as the tech Walmart. It's not just a tech company. It's a payment company. It's a service company. It's a consumer ecosystem company. And when people feel uncertain, they don't stop buying phones forever. They delay, and then they upgrade, and then they buy stuff from the Apple store. So when the market sells Apple off in fear, that's what disciplined money gets shaped. And I truly believe that Apple will be one of the best performing stocks toward the end of the year. This next company I'm going to talk about is going to kind of tie in a little bit different. And I want you to hear me when I say this. If tariffs are capped and the economy slows, what happens to housing? Just hear me. Just hear me. Because this one is a sleeper. Now, I'm not going to lie. I've owned this company for maybe about 5 years. But I dug it up because I want us to see something. This company is called Toll Brothers. This is where most people really will get confused. How can housing work if the economy slows down? I get it. Remember, Trump and his people bought billions of dollars in what? Mortgage-backed securities. Hear me here. Because housing is not just one market. It's multiple markets stacked in. Toll is the higher end. And higher end buyers are less sensitive to rates than the average buyer. Hear me. Just hear me. While Toll matters in this environment, it's simple. Well, concentration. We already talked about what? We in a K-shaped economy. The top half keeps moving and the bottom half keeps struggling. So Toll sells to the half that has income mobility, right? They don't have the supply chain constraint. Supply still considers. It's them. Even in a slow environment, supply constraints don't vanish overnight. And if the Fed turns more dovish later, if growth slows enough to where inflation cools, markets start pricing in cuts. And when rates get even slightly cheaper, housing demand snaps back. So Toll Brothers is positioned. They ready for the pullback. And I like this type of company in this type of environment. So I like Apple, I like Brady, I like Toll Brothers. Now, again, I'm not telling you to go buy these companies, but I think you should research them. All of them have good balance sheets, all have them good cash flow, and all of them have demand, things that we like. But number 4, they all have pricing power. Look, let's just look at it this way. The Supreme Court didn't just strike tariffs down. It changed the durability of policy. And when the durability breaks, markets move in waves. Sell-offs, relief rallies, and then the repricing. Well, we saw the rally yesterday. The market finished stronger after they heard that. Now, you don't get rich from guessing the headlines. You build wealth by positioning through the volatility. So the playbook one more time. BRC is the boring company. Yep, it's the winner in uncertainty because hospitals, warehouses, airlines, they need this. Apple is the scale winner if tariff pressure gets capped because now we know. And Toll Brothers is positioned for the turn. Now, when you put these together, the biggest mistake is not being involved in the market at all. And stop trying to wait till it feels safe. You got to take a little risk. So position yourself with percentages.